Assalamu alaikum for those who are just joining us. Jazakumullah khair. We will begin in just a couple of minutes. We'll just give a short opportunity for people to join the room, inshallah. Jazakumullah khair for everyone for attending today. I hope that everyone is doing well after the weather that we've been having, those of us in Ontario and Quebec and on the east side of the country over the past several days, almost a week now. Okay, Bismillahirrahmanirrahim. I'm going to begin by sharing my screen. First, thanking all of you for attending and joining. Today, we're going to be discussing registered retirement savings plan, how to save for retirement, what are the features of an RRSP. So let me begin by sharing my screen. Okay, Bismillah. So today we're going to begin regarding RRSPs, how to take advantage of RRSPs, what are the features of RRSPs, tax savings, investments, and more. My name is Siddiq Mohamed. I'm the team manager here at ShariaPortfolio Canada. So again, thank you again for everyone attending today's webinar. Now, first, a disclaimer, we're not going to be providing any individualized investment advice today. Any advice should be sought from one of our advising representatives. We can always book consults with them, inshallah, and there'll be some contact details at the end that we can arrange a consult with one of our advising representatives, inshallah. For today's agenda, first, we're going to give an intro into ShariaPortfolio Canada, a little bit about us, what we've been working on, as well as looking ahead to retirement. This is something that a lot of us would benefit from a little bit more, just in terms of understanding some of the needs that we'll have during retirement, as well as financially forecasting on how to meet those needs. We're going to go over some of the features of what registered retirement savings plans accounts have, different types of RRSPs, what are the taxable benefits or features of an RRSP account, as well as how to get started with an RRSP account. And then we'll open it up to some Q&A at the end. So first, a little bit about ShariaPortfolio Canada. We are Canada's first licensed portfolio management firm that's fully dedicated to halal wealth management. We were initially first licensed with the Ontario Securities Commission and have subsequently become licensed with other provincial security commissions in Canada. ShariaPortfolio in the US was founded in 2003, so about 22 years ago. It's a separate license in the US. Here in Canada, we have a custodian relationship with Fidelity Clearing Canada, which of course carries CIPF, the Canadian Investor Protection Fund, on all registered accounts, or all investment accounts up to $1 million. So in terms of halal investing, what does it mean to have a halal RRSP? So we manage all of our client accounts, the wealth management, according to AOFI, which is an acronym which stands for the Accounting and Auditing Organization for Islamic Financial Institutions. This is a global organization based in Bahrain. It's made up of scholars from around the world who have set a standard for Sharia standardization in the Islamic finance industry. And what that means, because a lot of people ask the question, what does it mean to invest halal? What does that mean to have a halal portfolio? Well, primarily, there are two levels of screenings that are employed where we're selecting stocks or public securities is concerned. There is first a qualitative screen, and then there is a quantitative screen. And look at what that means. The qualitative screen requires us to remove all companies from a portfolio that have qualities that are undesirable to Islamic law. That is to say, companies that are involved with activities that are against the Sharia. Like many of those are listed on our screen. There's things that many Muslims know, gambling, alcohol, pork products, things like this. Also, interest-based companies like banks are also excluded. We take all of these companies and put them aside. We do not hold them in our portfolios. Now that we've employed the qualitative screens, we then have to look on those companies that are left. We have to apply the quantitative screens, which means that we are looking at the company's financial statements. income statements, balance sheets. In particular, we're looking at three things. The first is that any cumulative revenue so the sum revenue of non-compliant activities plus non-operating interest income should not exceed 5% of total revenue. Okay, so this is the first thing. The second is that any interest-bearing debt over a 12-month average market cap, so 12-month price, should be less than 30%. And the third is that any interest-bearing investments over a 12-month average market cap or share price should be less than 30%. So these are the main financial metrics that we employ to screen companies for Sharia compliance. And again, these are the standards of AOFI that we follow, which is the global standard for halal investing. So when we're managing, when our company is managing an RRSP account, this is what our investment committee is using in terms of guidelines for Sharia compliance, where stock selection is concerned. This is extremely important for us as Muslims. And I want to pause here and I want all of us to consider a scenario. I want you to imagine an individual, a man. He goes to his local grocery store, his local halal grocery store, and he's buying chicken for his family. And he buys this organic grain-fed chicken that's been ethically raised, no hormones. It's all good grains. It was zabihad by hand. It was slaughtered by hand by a trusted Muslim brother in the community, and then it was cleaned properly, and then that he bought it and he brought it home to his loving wife, who then prepared his favorite dish with all of their ingredients from their own kitchen, and he sits down at his table to eat this meal, and the meal is haram for him. And I want you to just hold that in your minds for one moment. We're going to come back to it, but imagine that scenario for one moment and just hold it in your minds. We'll come back to it in a few slides, inshallah. So now that we've looked at how we manage portfolios, what are some of the RRSP fundamentals, some of the basic features of a registered retirement savings plan? So first, contributions made to an RRSP account are tax deductible up to your personal deduction limit. And we'll look at what that means, what your deduction limit is in a few moments. But anything that you contribute, you receive a tax receipt, which is then used to either provide you a lower tax payable on your income tax, or perhaps a tax refund, depending on your personal tax situation. That's what's one feature that helps with an RSP, is that it helps reduce your personal income tax in that year. And the deadline for this year, for 2024, I should say, is March 3rd. So it's coming up in just a couple of weeks. The second benefit is that any investment, from a tax perspective, is that any investment earnings that grow within the registered account are tax deferred. There are no taxes on growth, whether that be capital gains growth, whether that be dividend income growth. There are no taxes imposed at that time while the funds stay within an RRSP, while it's within the registered envelope. Also, the RRSP does have some flexibility for withdrawal with regards to using it for the home buyers program or the lifelong learning plan program. RRSPs can be used for these two purposes prior to retirement. However, they are taxed. Like if you withdraw for a home buyers program to purchase your first home in Canada, or for the lifelong learning plan, the withdrawal is treated as a taxable event in the year that you make it. And when an individual turns 71, the RRSP is converted to an RRIF, which is a registered retirement income fund. So the difference is that an RRSP, a registered retirement savings plan, is something that is contributed to. We make contributions to an RRSP so that the funds can grow so that when they become an RRIF, the account becomes a registered retirement income fund. We're no longer contributing to the account. Now we are withdrawing from the account during retirement. And those withdrawals at that time will be treated as income. So it is a tax deferral program with an RRSP. It's not tax exemption, it's tax deferred. You're deferring taxes until you withdraw at the age of retirement. The assumption there, which is a reasonable assumption to make, is that our income tax bracket will be lower at the age of retirement than it is or it was during our working years. So the taxes that are deferred should be less than those that we are paying now during our working years. Okay. What is the average RRSP balance for Canadians at age 65? We find that, and this is per Rate Hub, which is a fairly reputable site, in 2024, the average RRSP balance for individuals 65 years in Canada was just shy of $130,000. That was the average. Now, this number, as far as RRSPs go, is fairly low. So on average, on balance, Canadians at the moment are under preparing for RRSPs. We should have more in our RRSPs. Having said that, there are other accounts. We tend to be holding a lot more in non-registered accounts. These could be savings accounts, checkings accounts, and we have some in our TFSAs. But certainly having more in an RRSP does yield a higher taxable advantage for us. Now that we know the amount that the average Canadian is holding, how much does it take to retire? Or how much is the average person spending in retirement in Canada? So what we find is that the average, and this is per Statistics Canada, they released the stat that the average retirement income across the country is just over $37,000 annually. And this is made up of two things. About 21,100 are coming from their RRSPs and their pensions. And 16,100 on average is coming from old age security, guaranteed income supplement, Canada Pension Plan, Quebec Pension Plan. This is the breakdown of where our money is coming from. So we really do rely on RRSPs. If you look at the breakdown here, more than half of an individual's annual retirement income is coming from their RRSPs and their pensions. So this is something that's really important for us to be aware of, and how important it is in terms of putting away money for our retirement, because it's very, very difficult to, and with the rising costs of everything due to inflation, 16,100 from old age security, CPP, QPP, guaranteed investment supplement is income supplement is not enough. So we really do need to focus more on putting more money into RRSPs, so that we can have a more comfortable retirement. What is a good goal, or how much should we be putting into an RRSP? Ideally, by age 65, $450,000 is a good goal to have by age 65. If you would like to be able to, and applying an annualized 6% growth, compound growth to that figure, this is a very good, comfortable goal to have for retirement by age 65. And it's never too young you're never too young to start, and you're never too old either to start putting money towards your retirement. And I highly encourage everyone to start early. As you'll see in this table, and again, this is assuming a 6% compound growth year over year, this is the amount that an individual needs to be putting aside per month in order to meet this goal. Okay. Now you'll notice for an individual who's 18 years old, it's $144 a month. That's what's needed. If a person starts when they're 18 years old and they're putting $144 a month, that's all they need to do in order to have a $450,000 retirement at age 65. Now, Saying that to an 18-year-old, the response might be, well, that's a lot of money for an 18-year-old, right? But I'm going to remind you that it's still $144 when you're in your 20s. It's still $144 when you're in your 30s and 40s and 50s. It's still $144 at that time. So yes, it may be a lot to an 18-year-old, but it's certainly not a lot to a 30 or a 40 or a 50-year-old. It's very, very achievable. The key is to start early and to experience that compound growth. Because as you'll see, the later that a person starts saving and contributing to their RSPs in life, is the greater that number grows and the more difficult it becomes to achieve that goal. So it's very, very important to start young, even if it's a little bit. Start young and be consistent. Make a point of paying yourself first. Just like we pay our bills, we pay our cell phone, we pay our hydro bill and our rent and whatever other monthly bills we have. Make a point of paying yourself, your future self, every single month. Make that one of your bill pays and make it a priority. Because in doing so, your future self will be in a much more flush and comfortable financial situation because you made that preparation. Looking at what the average spend is in retirement. On average, the average person is spending just about $28,800 per year. And this is how it's broken down on a month-to-month basis. This is what the average individual, 65 plus, how they're spending money. About $442 on average goes towards food. This is groceries, the occasional dining out that we can do on a fixed income. Again, this is just trips to the grocery store mainly. About $581 is spent on rent or / mortgage or house payments and house-related payments. $167 a month is spent on entertainment. $282 a month is spent on travel. And on average, about $151 a month on medical expenses or health-related expenses. Those do pile up a little bit more as we tend to get older and we experience more health issues. Now, a couple of things that I want to point out here. This is the average for the average Canadian who's 65 plus. However, there are also individuals who like to travel more or do other things that they were perhaps unable to do when they were working or when they had their kids living with them. Now that they're older, they're 65 plus, perhaps the kids are no longer there. And now it's just the husband and wife who are now retired, and they want to take that trip that they weren't able to take when their kids were with them, living with them, or they were still working. So these are additional expenses on top of this as well. And there are, as we'll see in the next slide, there are other major expenses like travel or having to replace the roof on a home or having to replace a vehicle that become more challenging on fixed income, which is what we are during retirement. So again, just building up that RRSP is really important. And just to close the loop on that mental image that I all had us imagine, that individual who went to the grocery store and he bought his halal chicken hand slaughtered and he brought it back and wife prepared the meal and the food was haram. Many of you could be possibly wondering, well, how is that possible when the chicken from beginning to end was halal? Well, if the chicken was purchased with haram money, then it becomes haram. And this is an important consideration. And I want us all to consider this, because if our investments are not halal, if we're not owning securities and stocks that are in our portfolios that are halal, then the money that comes out of that at the end when we retire will not be halal. And we need this money at some point when we are retired. So it's very, very important that we know what our funds are invested in and what we are holding as our investments. Because as Muslims, spiritually, we have a responsibility for everything that we own. And this includes stocks in our portfolios. We have a responsibility. So at a minimum, we have to know what it is that we're invested in, and we have to make an attempt and an effort to make sure that we are invested in things that are in accordance with our values and not in disagreement with our values. And this is what we here at ShariaPortfolio endeavor to do for all of our clients, is invest our wealth according to our shared values. So getting back to some of those big spends that can maybe catch us a little bit off guard in retirement, this is looking at things regionally because prices are different across the country. We will notice that in places like Quebec, Ontario, and British Columbia, housing prices are higher than they are in other places of the country. So the majority, the top, I shouldn't say the majority, but the top item that we're spending money on in retirement is housing, whether that's a mortgage or whether that's a rental payment or whether that's property taxes. Even if the mortgage is paid off by that age, there might still be property taxes. So housing is a big ticket item. And when we look at the amount spent on expenses annually, the highest is actually in Ontario. It is actually, sorry, in Alberta. The second highest is in Ontario, followed by the national average. So these two are above the national average. The lowest being in Atlantic Canada, right, in the Maritimes. And there are, if we look at the majority, sorry, not the overwhelming, but the majority of individuals who are 65 plus did still make a purchase over $10,000 after retirement. For many of those, that purchase was a vehicle, was a car. So it's something that we need to account for. We need to plan for and anticipate that, just because we're on fixed income and we're retired doesn't mean that we're not going to need to change our car at some point during our retirement, and that could represent a big chunk of our retirement money that we need to forecast for and account for. So let's get into some of the features on different RRSP plans, different registered retirement savings plans. We'll talk about the tax benefits for contributing as well as investment growth. So first, to define it again, just so that we're fully all comfortable, an RRSP, it's a savings account that's dedicated to help supplement retirement. Now, and all of us were allowed to contribute up to 18% of our previous year's earned income. So your contribution limit for 2024 will be determined by your 2023 earnings, or your what you filed with your taxes. Will be 18% of that earned income. There is a limit that's set by CRA annually. For 2025, the annual limit is $32,490. That's the most, regardless of how much you made. That's the most anyone can contribute. And any unused contribution from previous years is carried forward. So if an individual has not contributed to their RRSP, say, for example, the 18% of a person's previous years came to $18,000. The person was earning $100,000 a year over the last 5 years, and they had $18,000 of contribution, but they didn't contribute. Well, those $18,000 year over year are cumulative. So this year they can actually backtrack and contribute that full sum. It's carried forward, and contribution room is carried forward indefinitely. So if an individual has not made previous year's contributions, they can make a larger lump sum payment or contribution to the RSP if they have those funds available. It's indefinite. The best way to know what your own personal RRSP contribution room is to check your notice of assessment, which is accessed through your CRA online portal. So if you just log in, check your most recent notice of assessment, it's going to show right there your RRSP deduction limit is, and there's going to be a figure that's the amount that you can invest in. That's the best way of really knowing what your own personal RRSP deduction limit is. There are different types of RRSP accounts, and we're going to talk about 3 of them here. There's an individual RRSP, which is the most common. There is a spousal RRSP, which is an excellent plan. I really want everyone to be aware of this. And there are group plans, group RRSP plans. So let's look at these 3 together. First, an individual RRSP. This is by far the most common. It's only one person that's named on the RRSP, and that one person is contributing to their own retirement plan. So this is, your retirement plan in your name and you're making the contributions. Anyone can have this RRSP account. You just have to be 18 years of older, as with all other registered accounts. And away you go. You can start contributing to your RRSP up to your deduction limit. The second is this that we're going to look at is the spousal RRSP. And this is a very effective plan and a very good plan for especially for individuals who are in a higher earnings situation. So in this situation, an individual is contributing to their spouse's RRSP, not their own. They can also contribute to their own, but they're also contributing to their spouse's RRSP. And the benefit of that is that the individual who's making the contribution gets the tax receipt, even though they're not the owner. The owner of the account is the spouse. So just to give you an example, there's a husband, there's a wife. Perhaps in this hypothetical situation, the husband is earning more income than the wife. So the husband, in addition to his own contribution, can contribute to his wife's spousal RRSP account. So he's putting the money in, he's getting the tax receipt. So it's helping to further reduce his taxes because he's in a higher earnings bracket. This is more beneficial for him. Now at the end, because the account is in her name, in the wife's name, at the end, when the account is converted from an RRSP to an RRIF, she will be the one, the wife will be the one who will withdraw, and she will pay taxes at that time for those withdrawals. But again, the assumption there is her tax rate will be much lower. So this is a great plan for individuals who are in a higher earning bracket, individuals who perhaps they earn more than their spouse and they want to further save on their taxes and give the spouse the benefit at the age of retirement. And then we have group RRSPs. And this is typically offered through an employer. So many companies offer a group, either it's a defined benefit plan, defined contribution plan, or group RRSP plan. And oftentimes these contributions are made through payroll deductions. So in the same way that there are source deductions where we're paying taxes and EI and different things to the government, the employer will take a little bit of the paycheck and contribute it to an RRSP plan that's managed by an administrator retained by the employer. So sometimes, we'll see other institutions that can set this up. And here at ShariaPortfolio, we're also able to set up group plans for employers and manage it according to our shared values. The benefits of these plans are that first, this is automatically just coming out of your payroll, so you don't have to think about it. It's easy. The employer is kind of managing your RRSPs for you. Often these plans do have lower management fees because it's a group plan, there's more volume. And oftentimes the employer may match contributions as well on a percentage basis. So sometimes an employer will match, say, 3%, 4%, up to 6 or 7% of the contributions that you're making. The employer, out of their pocket, will also put into your RRSP. So it helps to accelerate the rate of growth because there's more contributions going into your account. So these are the three most common types of RRSPs out there. There are, of course, other types. There are locked-in retirement accounts, which cannot be unlocked until retirement age. There's also pension plans. We're not going to go into all those today. We are going to keep the discussion to these three most common RRSP types. Now, let's look at some of the taxation and tax benefits of an RRSP. So, because this is the number one reason why a lot of individuals put money into an RRSP is that it helps them. Yes, it helps your future retirement, and you're paying your future self for your future income at the age of retirement. But you're also getting a tax break today, and this is an added benefit. So any amount that you contribute to an RRSP up until the deadline, and again, the deadline for 2024 is March 3rd of 2025. So it's coming up in just a few short weeks. But anything that's contributed, you do get a tax receipt for your contribution. And that tax receipt is then used to reduce your personal income tax when you're filing shortly after. So you get an immediate benefit today. You get a bit of a tax break today for making that contribution. And what a lot of individuals do is, if it creates a tax refund, so for example, if a person puts several $1,000s into their RRSP account and it creates a tax refund, what makes a lot of sense is just take that tax refund and put it right back into your RRSP, because now you're contributing for the current year, effectively guaranteeing you're going to get that receipt to help on your future taxes as well, on the future year's taxes. So and then you're getting the entire year in addition to that of hopefully some growth depending on market conditions as well. So, and that growth that happens within the RRSP account is tax deferred. So as long as the funds remain registered, as long as the investments are in the account and are not taken out, there are no capital gains taxes, there are no income taxes, there's no dividend taxes, nothing like that, as long as the funds are within the registered account envelope. The funds are not deregistered. So these are very considerable tax benefits for investing in an RRSP. Is you get the benefit today, and then you get the benefit of the tax deferred growth as well. Having said that, when we do reach the age of retirement and we're ready to stop contributing to an RRSP and convert it to a registered retirement income fund and start making withdrawals, at that time, those withdrawals that we're making annually will be considered part of our taxable income. So that's an important consideration, that when we're withdrawing from our registered retirement income fund, we have to be aware that, those withdrawals are income at that time. But again, at that time, we're going to be hopefully in a much lower tax bracket, as we're not earning wealth like we were when we were working our careers or our jobs or whatnot. But now it's just fixed income from our retirement. And of course, the amount of tax that we will pay at the age of retirement depends on the amount that we're withdrawing, because in Canada, of course, we do have the tiered tax bracket system, as well as the province that we're doing it in, because each province has different taxes as well. So it's important to consult a tax advisor when we are going to be taking funds out of an RRIF, to figure out the amount that we need to take out and still make it as tax advantageous or beneficial as possible for us. Now, one of the important considerations is that because the government is giving us that tax receipt for contributing up front, the government does want us to leave funds in the account until retirement, or use it for the home buyers program or the learning plan, the lifelong learning plan. They do not want us to withdraw from the RRSP prematurely. So, and there are heavy source deductions should an individual elect to withdraw from their RRSP prior to retirement, and not for the home buyers program and not for the lifelong learning plan. They're just taking money out because of an emergency or some other reason. In that event, the government will impose withholding taxes at the source, which are fairly severe by way of our tax structure. Up to the first $5,000 that a person withdraws, they will be taxed 10% at the source. So this money never gets into their hands. It's sent from the institution directly to Revenue Canada. Between $5,000 and up to $15,000, it's 20%. And for amounts exceeding $15,000 that are withdrawn, it's 30% at the source. So these are pretty heavy taxes. So as knowing this, we should only be putting funds into an RRSP that we know and are very confident that we're not going to need until retirement. Anything else like emergency money or funds that we might need for buying a new car or taking our family for Hajj or replacing the roof or any other major capital expenditure should really be in a tax-free savings account, because there's no penalties for withdrawing. In addition to these withholding taxes that are on the screen here, there is also income tax as well. that are payable for those withdrawals prior to retirement. So really, I want to impress upon everyone that don't withdraw early from your RRSP unless you absolutely have to, unless it's a dire emergency. And if you do, be aware there's a major cost for it. Here at ShariaPortfolio, for those who are interested in having their RRSPs moved over, it's a very, very simple process. We're able to transfer individual RRSPs and spousal RRSPs, non-registered accounts, TFSAs. If you have a group RRSP from a previous employer, so an employer that you're no longer with, and you've received that package and you're able to move that, we can do that, as well as pension plans. So from a former employer, like a LIRA or a locked-in RRSP. The only registered account that we're really not able to move is if you have a group RRSP or defined benefits plan from a current employer. So if the employer that you're with now is matching contributions, they're paying and things like this, that plan most likely cannot be moved until you leave the employer. But I would encourage everyone to reach out who do have accounts that if you'd like to consider having them invested in a way that's in accordance with our values so that your retirement income is halal. This is something that we can assist with. Our client service team can handle most transfers very, very seamlessly, very smoothly. And of course, we are always happy to make introductions to our advising representatives who can also assist with, recommending which investment model is best for you. This is something that we can also facilitate. So my contact is here on the screen. I'd like to thank everyone for attending, and we can open it up now for any questions that anyone may have. Okay, so one individual who is an existing client is saying he has an RSP with us and wants to contribute more, but can't do it through the website. So for that, the best thing to do is to contact your advisor, and they will be able to let you know how to make those contributions. It's a very simple bank transfer, but we'd be happy to let you know how to do that. The next question, thank you for that question. The next question is, I mentioned average expenses per person. Were they per person or per couple? Excellent question. Thank you. These were per individual. So this is the average spend per individual. If it is for a couple, not all expenses are necessarily going to be doubled. For example, housing costs are not necessarily doubled. Transportation costs are not necessarily doubled, but some things are, such as food, for example, or medical expenses that are more personal to the individual or consumed by the individual. But yes, very good question. They are per individual. The figures that I share were per individual. Next question is, if someone dies, what happens to the RSP and RIF account? Very good question. So in the event of a person's passing, as with all of their assets, they will be treated as being subject to inheritance after any estate taxes that are imposed by the government. So if an individual has a will, and I do highly recommend that everyone should have their will notarized and properly filed, then the RSP would get passed on to their surviving spouse or beneficiaries named in their will. If anyone here needs assistance with wills or anything like that, we do have a third party that we can refer you to that does specialize in preparation of Islamic wills, and I'd be happy to make an introduction for that. Next question. Are employer-provided group RSP included in the limit? Excellent question. Yes, all contributions to an RSP are included are counted towards that deduction limit. So if an individual is having a deduction limit of $18,000, just going back to our hypothetical situation, and they're contributing $10,000 and their employer is contributing $8,000, which is unlikely to be that high, but just for our scenario, yes, that government portion does count. Everything that goes into the RSP is a contribution, whether it's from the employer or from the account owner themselves, does count towards the deduction limit. Excellent question. Thank you. The next question is, can I have my pension paid into a RRSP? Okay, so regarding your pension paid into an RRSP, pensions are paid typically after retirement. So I'm going to ask for you this question. I would need to have a little more information on your situation in order to answer that question. So I will ask this individual who's asking this question to reach out to me directly, please, because we need more information there. Next question is, what happens if I exceed the limit? So an individual who exceeds the limit on RSP contributions will be fined by Revenue Canada. And it is a monthly fine. So it's really best to not exceed your deduction limit. Any excess RSPs that you have beyond that you want to make beyond your contribution limit, you should consider perhaps putting into a spousal RSP. If you have excess money that you need to invest, put it into a spousal RSP. And if you still have extra on top of that, put it into a TFSA. And if you've maxed out your TFSA, then put it into a non-registered account, into a cash account. But it's best not to exceed your limit, because then you're being fined a monthly fine by Canada Revenue Agency. Is it required to have a will in Canada if you have RSP and TFSA accounts? So technically speaking, having a will is not a legal requirement. It is highly recommended. Because in certain provinces, like Quebec, for example, you cannot name beneficiaries on registered accounts. So a beneficiary cannot be named on an RSP or TFSA. The disposition of assets at the time of death is really done according to what is stated in your last will and testament. And in the absence of such a will and testament, it is then whatever is determined by Canadian law. So what I recommend is to have a will, because it is possible to have a will that is drafted according to our values as Muslims, that is also in accordance with Canadian law and is recognized by Canadian law. You can have both. You can have one document, which is your last will and testament, that is in accordance with Canadian law and Sharia law. So yes, it's not required to have a will, but it is highly recommended. And if I have exceeded, can I move my RSP to a group RSP now? For RSP transfers, if a person's exceeded, they would need, and they want to move it to a group plan, they would need to discuss that with their employer or the plan administrator within who administers their group plan by their employer. Oh, sorry, he meant not the person. Sorry, not group, but I meant spousal. Again, we need to get a little more information on that. So I would ask the individual who's asking that question to please reach out to me directly, so that we can answer that question, inshallah. Okay, great. Well, Jazakumullah khair. I want to thank everyone for attending, and again, please do your best to get your contributions in before March 3rd. For anyone who is interested in learning more about having a halal RSP, please feel free to reach out to me directly. And in advance, I would like to wish everyone a Ramadan Mubarak in advance, inshallah, as we enter we're in the second half of Sha'ban. And inshallah, I look forward to seeing you all on the next webinar. Thank you very much. Assalamu alaikum wa rahmatullahi wa barakatuh.